So let me bring to the show Philip Streible, Blue Line Futures, Senior Strategist, Blue Line Futures. Good morning, Phil, and thank you so much for joining us.
Thank you for having me.
Phil, let me just kick off very quickly with the macro data, because of course if we didn't have the war here in Europe, this was about to be the major story of the day, because we do see once again inflation pressures to the upside in the US, and probably the most important point is that we do see it month over month data, both core and normal PC headline inflation. So I was wondering, what's your first take, and what do you think is supposed to be the Fed's reaction?
Well, yeah, as soon as the data came out, there was a couple different things that kind of stood out to me. One, we saw bonds continue to sell off on that news, which means that those interest rate hike expectations have come right back front and center. Also, we saw the consumer spending data come out better than expected, and that's what accelerated the U.S. equities higher. So the belief is that consumer spending increases, the path to the economy coming back is still alive.
And do you think, actually we saw a little bit of statement yesterday from different, Fed governors, and few of them are suggesting that probably the correct approach, Williams specifically, is to hike rates by 1 percentage points until June. So do you agree with this, or do you think it's too aggressive considering that the stagflation talks are here?
Yeah, if you look at, so economic data will decelerate going forward until about May and June. And it's going to get tougher as the year goes on. When the Fed is tightening into that declining economic cycle. If you look at, the Fed cast model that tells you what the expectations are for the interest rate hike, about a month ago it was a 60% chance that the March hike would be a 50 basis point hike. Coming into yesterday's morning, it dropped all the way down to 6%. But now that you see that Ukraine and Russia appear to be going to engage in some constructive talks, now bonds are selling back off. Those interest rate hike expectations are coming right back. So I think 50 basis points is definitely still on the table.
Let me ask you, first of all, before we move, of course, to energy market, on the other side, what are your expectations in terms of, market's reaction of everything that's going on in Ukraine? Do you think that more panic selling is here, or what is the market suggesting with this sudden surge in futures, in stock futures?
This is specifically wartime volatility. So volatility is going to remain high, and it's going to remain high for a while. I mean, people are really on edge, and you can see they panicked out of the market over the last couple days, and now they're panic buying back in. The U.S. equities, though, they've got so much resistance going higher that I think you really, if you are concerned at all, you need to lighten up on any kind of significant rally.
And of course, the energy market, which is extremely interesting. We do see crude oil prices hovering around the $100 per barrel, which is certainly very high levels. But the Brent is at $97.50 per barrel compared to the $104 per barrel that we saw yesterday. US oil at 92.80, off about 0.8%. So I was wondering, what is your short-term target?
We are definitely going to scale in on oil for our clients, but we'd like to get the front month WTI below $90. So call it 89, 88, and we'll scale all the way in if it drops down to 85. The only way you get that movement down is if you get that Iran nuclear deal and some more oil flows on. As far as Russia, they can't take them off as SWIFT because they deal all their energy, and that's how they receive compensation. So you're seeing energy demand out of Europe had really significantly picked up in the last 48 hours as they're trying to secure any kind of supplies that they need.
And on the other side, we do see also gold prices slightly lower today. We're talking about a futures, of course, 0.5% lower. So where do you see we're going to see the gold in the following weeks?
You had that panic buy yesterday, obviously. I mean, that was incredible news, terrible situation. And then it was that decline on expectation for the 50 basis point rate hike. That was the 1-2 tailwind that it got that shot it up to 1975 on the panic buy. We always encourage our clients not to chase these markets, wait for them to come back to you. So I think that gold could settle back down, get into the 1860s. That's where we're going to look to scale in, because we know that the Fed, the number of rate hikes, we do not agree with that they will be able to do, 7, 8, 9 rate hikes. We do not agree with that. We think it's closer to 3 or 4 rate hikes before they stop citing financial uncertainties.
So do you think that the Fed has to consider also what is going on here in Europe?
100%. It will impact the global economy. They're trying to deflect and say that it won't, but it will. And, we are also concerned that, this could lead the path where China tries to take over Taiwan. So we are very cautious on U.S. equities, again, lightening up on if you're long, and then on gold scaling in on declines.
Are you concerned about energy prices in the medium to long term? Because, of course, inflationary pressures tied to energy prices is not something that the Fed is able to control.
Well, yesterday, as soon as I saw the news, I went and filled up all 3 of my gas tanks in my cars. So, I am concerned about rising energy prices. And across the U.S., you look at, gasoline prices are continuing to move higher. I think we're at $3.54 for the national average, but you get into, certain states, they're $4 or $5. So there are steep concerns about it.
Thank you very much, Philip Streible, Senior Analyst, Blue Line Futures. Thank you for joining us and have a great weekend.
You too. Take care.